Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for August 1st of 2022. Please see our disclaimer for important information. In our high frequency data for the week, we can see a few positive elements here. Obviously on the weekly basis, we've got hotel occupancy. We have open table restaurant numbers that are looking a little bit stronger than they had over the near term. We've got TSA checkpoint data, which is a little bit down. We're in kind of that ebb and flow of the summer where you have pockets of real high travel and just kind of high travel overall, although that part has been a little bit weak. Supply of motor gasoline has picked up a little bit, both in the last week and the month, with lower prices for gasoline. Global commercial flights, you see us down a little bit. Steel production, positive. Rail car traffic, positive over the last month. Consumer confidence index has continued to fall a little bit. Now, this is not to be confused with the consumer sentiment indicator, which is put out by the University of Michigan, which tends to focus a lot more and be influenced more so by inflation expectations. But we see here consumer confidence as they're looking at their price basket, particularly on food right now, but still also energy, which is up 40% year over year in the aggregate. You can see the confidence continues to wane. And we had a lot of data last week, and we're going to hit on a couple of these high points here. Obviously, we had the rate increase. We got 75 basis points. We're now at 2.5%. I got a few charts here on that, so you can see that on the left-hand side where we've come off that lower bound after having, before the pandemic, you see those little stair-step increases. On the right-hand side, you see the market is pricing in. It's actually pricing in 60 basis points, but more or less what they're doing is they're expecting another 50 basis point hike when we get to the September 22 meeting here coming up in a little over a month. And so that puts us there at 3%. And then if we look here, this is the market pricing for the Fed funds rate by the end of 2022. So basically, as I said, we're at 2.5% right now on the Fed funds target rate. Market is pricing in about another 50 to 60 basis points, essentially another 50 half-point hike in September. And really, this is telling us here that the market expects the Fed just to kind of hold off at that point. As we know from prior charts of the week and some other data, which I didn't include here, that they're actually, market is now beginning to price in actual rate declines for 2023 as the prospects of a recession continue to loom. But at least right here, market expects basically one more half-point increase, and then the Fed holds off for the rest of the year. One of the most important numbers we got last week was the much anticipated GDP number for the second quarter. As you can see here, we've got two different graphical representations, and I think it's important to look at the internals of where we got to that number. And so just to kind of dial back a little bit, the first quarter GDP number on an annualized basis was negative 1.6, and so we wound up getting negative 0.9% this time, so 2 consecutive quarters of negative growth. But the internals look markedly different, and I think that's going to be important to some degree as we go forward. And you can see here in these brightly colored segments of these bars for each of the last 6 quarters, you can see the composition is actually very, very difficult. And so where, like in this time last year, we had a much stronger contribution from net consumer spending, and so that was very strong. Well, that has obviously tailed off as we've seen inflation and economic slowdowns and real purchasing power going down in the face of that high inflation. So consumer spending was not as much of a contributor as it was this time last year. Now, the latter half of last year, we had a tremendous amount of inventory buildup, and so that has actually gone the other way now. In fact, inventories were the real bugaboo for the second quarter, and they were a net drag on economic performance in the first quarter, but not to the degree that we saw here over the last 3 months ended June 30th. Now, the issue in the first quarter was actually net trade. So we had a significant trade imbalance. It was our imports that was weighing us down in the first quarter. And then the second quarter, that actually reversed itself. And so despite the strong dollar, we had a surge in exports. And so that actually helped make this number better than it otherwise would have been because of the inventory drag. And you can see on the right-hand side, a different representation of this. So inventories, we just mentioned, was a major drag. Consumer spending on goods, and you're going to see down at the very bottom, consumer spending on services. Now, the net of both of those was a positive. So we did see positive contribution from the consumer this quarter. It's just that goods spending was a drag because we know that that's tailing off, and spending on services, which is exhibiting higher inflation right now, is actually going up. But net trade was a benefit, and consumer spending on services, and just about everything else in that equation was negative for the quarter. And here's a trend line view of the GDP number as we've now updated it. So, back in January of 2020, again, before the pandemic, we had a projection for GDP coming out of the Congressional Budget Office. Now, obviously, the circumstances have changed, but looking at their trend line, you can see that on a real GDP basis, we're basically not where we were anticipated to be. So, even though growth has picked up over the pandemic, we know that's well established, but in real terms, we haven't regain that trend line that we were used to before the pandemic. So a big question emerges now that we've had 2 consecutive quarters of negative economic growth. Now, does this mean that we're in a recession? And you've heard me say that I think that there's, at times like a 30% probability that we are in a recession. But what's really uncanny, and again, you hear politicians talk about this now too, that the National Bureau of Economic Research has a market dating committee where they actually sit and analyze the data, and then they determine whether we were in a recession or not. And this always happens at a lag. Now, 2 things here that I think would go against the notion that we're in a recession, and it's gross domestic income, as well as the labor market. And we know the labor market's very strong. That's on the right-hand side here. And you see the trend line in 22 versus some of these other periods that have been since recognized by the NBER as recessionary. So you see that being relatively strong. But then on the left-hand side, this is real personal income, which has remained pretty strong despite all. Again, real means that it is inflation adjusted, so we're weighing inflation against that, and so we know that it mutes it quite a bit. But you can see these other instances where we've had recessions. You see the preponderance of these observances are negative after this point of origin here. And so again, what the NBER and their dating committee looks at is not just GDP, or gross domestic product. They also look at gross domestic income, GDI, and basically the total of both of those is what's known as gross domestic output, or GDO. And so GDP is the one that gets all the publicity, but GDI has actually been pretty strong here. And I think that would be that coupled with the fact that labor market is pretty strong would be a reason to assume that we were not in a recession. At least not yet. And here's a quick look at the global landscape. So just to understand that this is not a U.S. phenomenon that we're dealing with. Now, obviously, Europe, we've talked about at length about some of the problems there with energy and the economic health backdrop that I think unfortunately the energy situation kind of propels them into. But you can see here that all of these forecasts, now this is the International Monetary Fund, so they actually just came out and sharply revised downward their estimate of economic growth for the year. And you can see emerging economies probably looking better than the rest of the world, but still from an investment standpoint, lacking a discernible catalyst to want to make, I think, make me for sure, want to jump back into emerging market exposures. But you see the world and then advanced economies have been adjusted down more so than the rest of the world. And here's personal consumption expenditures, and as we get a derivation of this, and you got two different views of this. Services is become a real strong contributor, and I'd say continues to be a strong contributor into PCE growth, and you see that both on the bars at the top in the blue area. Certainly over a fairly recent to intermediate memory, and then down below you see the percentage contribution. So it's moving higher as a percent or a share of nominal personal consumption expenditures at the expense of goods, and we do see goods rolling over. We saw here previously already in this chart pack that consumer spending on durable goods is down while services is up. And so you can see that kind of in this slide right here. Well, here's inflation adjusted personal consumption expenditures, or PCE, the change from level in essentially before the pandemic. And you can see where in the aggregate goods spending is higher than services, but you can see the rate of change, if you kind of follow that towards the end on the left-hand chart, you see goods is beginning to trail off, services continues to move higher. On the right-hand side is a change in prices, and you can see how that's moving. So essentially PCE on all items is moving higher, but in some cases you're seeing PCE excluding food and energy roll over just a little bit. Here's a compensation chart for U.S. civilian workers, a change from the prior quarter. So we do know that compensation is moving higher. You can see here in percentage terms, this number really represents like 1.4%. This is seasonally adjusted. This is data that obviously comes from the Labor Department. The challenge right now with incomes moving higher, and you can see this trend line that goes back to the beginning of the decade, on a quarter-over-quarter basis is actually pretty high, but the problem is that we are still trailing inflation right now. So real wages are going down, but essentially in some form here you can take this quarterly number and then just multiply it by 4 to kind of get to what that annualized number would look like. Here, basically 5.6% if you look at the latest data point. Percent change in the price index for PCE quarterly. And so again, we're drilling down on this just because it has a lot to do with a lot of the economic forecasts that are out there. And you can see PCE on both the left and the right. Right is just essentially quarterly price changes, and you see that those have been fairly muted. Obviously there was great dislocation with the shutdown and then the ensuing recovery, but this is a quarterly number, and you can see that that's mildly positive. You can see it's been steady over the last couple of quarters. I think it does remain high, but it does come down a bit as we get into the third quarter, and certainly by the time we get into the fourth quarter, we expect to see that begin to roll over. Here's consumer spending on groceries, and we see that inflation adjusted, obviously the basket of goods, basket of groceries that you buy at the store is more than what it was. Meat prices are higher, dairy, a lot of, when you think about even the packaging is more expensive. So these retailers, manufacturers are able to pass it along to the retailer, and the retailer is just simply passing it along to the consumer. You can see in current dollars, very strong inflation, but in inflation adjusted dollars, which will tell you what the impact of inflation is on aggregate demand. So people are buying less. They're buying. We've seen a share change to favor more greatly favor the in-store brands. So you can see the impact there. And then inventories at U.S. retailers. And again, inventory was a big headwind, and I think it likely remains so. You can see, motor vehicle parts. That inventory is down, but if you exclude that particular category, inventories are relatively high at a time where demand is clearly slowing down, not precipitously, because we do know that consumers are using their credit cards to fill in the gap between real wages and their desired consumption level. Here's inflation-adjusted consumer spending change from first quarter to second quarter. And so you can see here these categories: food services, accommodations, that's higher. Recreation, we've seen a clear interest in people wanting to get out on the road and travel, and there's a lot of pent-up demand for that. Healthcare has gone up. Transportation services are up. And you can see the big categories here that are a drag on this consumer spending: gasoline and other energy, groceries, and recreational goods, and home furnishings as well. So you can see the impact on these kind of more volatile items that get stripped out of the core numbers that we see for CPI and what have you. Groceries can likely to continue to be high, although we've seen a fairly strong drop. We'll see this in a second in things like corn off of their peaks, but gasoline prices are still 15% off their highs. They've been down. They're down quite a bit relative to a month ago, and so those elements should perhaps become a little less muted, become a little bit more muted in terms of their impact on consumer spending in the quarters ahead. I have two charts here talking about the consumer and looking at this gap between incomes and savings, or can't support living standards. And so we know that a large part of the population got stimulus checks, and the higher income cohorts saved that money, with the lower income cohorts went out and spent it. And so you develop spending habits, and then when you find that real wages are beginning to roll over, then you have kind of a gap. And then so how do you fill that gap? Well, on the right-hand side, you see that credit card volumes were at a record level in the second quarter. And so these are all the different issuers, whether it be American Express, Capital One, Discover, so on and so forth. But they're all higher on a year-over-year basis, and this gives you a little bit of cause for concern here. If you're sitting on the precipice of of recession, and you have people responding to inflation by pulling out their credit card, then you have these balance increases, and that's not really sustainable. So we definitely want to watch kind of the consumer spending net of these types of increases. We want to monitor how the consumer balance sheet is potentially going to erode with all this debt being put on their balance sheet. And so when you get into the situation where consumers are now loaded up with debt, they bought a lot. We go through periods where we feel really proud of the consumption numbers, but then we realize that to get there, that we had to leverage up the consumer. We certainly don't want to see that. So this will be something that we're going to want to monitor very closely going forward. Well, as we mentioned before, a large part of the commodity basket has come down rather dramatically. And you can see here corn and wheat, both of which would be impacted by the Ukrainian invasion by Russia, are now actually back down to their pre-invasion levels. Now, that's not to say that they're necessarily cheap, but they've come down quite a bit. And so this is helping input costs for different foods and cereals, and you can think all the things that corn and wheat go into, not the least of which is blended fuels with ethanol that use corn. But clearly the commodity basket has come down. Now we'll talk now about housing for a brief second, because I think you're seeing kind of the multi-headed horseman play itself out here. So, we were all belly aching over this unsustainable rise in home prices. Well, in the upper right-hand corner, you see the Case-Shiller National Home Price Index, and this is essentially a year-over-year change. And so that's up over 20%, and it's been there for a little while. And so prices continue to move higher, which is now actually causing some demand destruction, particularly with the inflationary environment that we've been subject to this year. On the left-hand side, you can see single-family home sales. These are new home sales, and you can see that they're dropping. Again, they've got a long way to drop before they get down to the levels that we saw in the global financial crisis, but they're clearly in a downtrend. And as a result, you see in that middle chart down towards the bottom, this is the mortgage applications index, and then it's actually overlaid with pending home sales, and you see both those numbers are moving down. So if you're in the mortgage market, if you're in the real estate brokerage market, the market itself is normalizing a little bit because there's inventory picking up, there's in days on market is beginning to extend, but clearly, even if mortgage rates are not necessarily, moving a lot higher because the 10-year Treasury has come back down, it's still causing a lot of consternation. And basically, the affordability is still challenged by virtue of these year-over-year price increases, which is causing a destruction in demand. As we like to do, we highlight some of these regional Fed surveys, and here in particular is the Kansas City Fed Manufacturing Index rolling over, not a terrific surprise. Expected activity in 6 months showed a very interesting increase. And so I think that in and of itself is perhaps worth noting. Now we have gotten a lot of earnings reports from companies where CEOs may be a little bit more optimistic about their own prospects than they are about the overall economy. But at least from a manufacturing standpoint, there is some room for perhaps some optimism, even though it might be a little volatile in getting there. Now we'll transition into the investment markets here. So the S&P 500, we know, is on a bit of a streak here, and which is really ironic given the data that we saw. Obviously the GDP report, we had the Fed rate increase. I think to some extent the market is pricing in a little bit more certainty about where this is all headed. And I don't know that there's a lot of ambiguity on whether we will eventually hit recession. Perhaps more a matter of when, although there's some people that are pretty adamant that we're in one right now. And I'll submit that there are, certainly from a consumer standpoint, when you were seeing your grocery bill and your gas bill at the same time, you probably thought you were in a recession. But clearly the equity markets are beginning to look forward to that. They've already priced in these rate increases, and the markets are not cheap. You look at the price to earnings multiple on a forward basis, maybe a little closer to 16-ish, a little over 16. Maybe that's a little higher than the long-term trend. So they're not cheap. They might be fairly valued. Obviously, a lot of people are concerned a bit about earnings. You can see the volatility index has come down quite a bit, even though, relative to the end of last year, it's up fairly significantly, kind of back to the same levels that we saw in late 2020 and in the fourth quarter of 2020. But again, volatility is not exceptionally high. I mean, I don't think that this whole market has really, call it, capitulated yet, but we've just kind of acquiesced. We've transitioned from this feeling of this anxiety over high inflation to this somewhat anxiety over slowing growth. Here's earnings estimate, Brett. So before we get really too carried away about earnings, and we are seeing, a modest growth in earnings and a modest beat, although the numbers are a lot smaller than they usually are in terms of companies that are reporting ahead of expectations. But the one thing that is absolutely worth noting here is the breadth. And here you've got the S&P 500 overlaid with the essentially the breadth indicator, and it just shows you that outside of energy, that you have seen a lot of outright earnings declines. And so energy is really the bellwether, kind of leading the rest of the market, even though it's a mere fraction of the index. But you're seeing the breadth begin to draw down a little bit. Here is the global dividend indicator, and it shows it's actually overlaid with the ISM manufacturing index. And so this tells you is that you, in this environment, you're getting better relative performance out of your dividend payers than you are the non-dividend payers. Again, this goes to the notion that you have more financial stability if you're paying dividends, that you have more demonstrable cash flow than the non-dividend payers. And I think that's important consideration here, just as you look at the whole opportunity set out in the investment markets, that dividends are actually providing a pretty fair upside over the market, even as the market is fairly weak. And here's something else I thought was extremely interesting. So, we always talk about, the dollar and its impact on earnings. We obviously saw the positive influence from net trade over the last 3 months into June 30th because we had a surge in exports despite a strong dollar. But this just goes to show you across the spectrum of S&P 500 companies that you have some that have a fairly important revenue sourcing from international markets. And you can see that highlighted in the light blue as you get in over to staples, materials, information technology, much higher component of international sales, which could be influenced if you have rapid dollar changes. And these are the areas where if the dollar is strong, you're shipping overseas, and at least from the perspective of the foreign buyer, that your goods that are being shipped out of the U.S. are more expensive. And so, I think this whole theme of what's going to happen to earnings and how is that going to impact the market. Valuations have come in, like I said, we're fairly valued. I think earnings are at some risk of being downgraded. I think to the extent you continue to have a strong dollar, I think this chart tells you that there's clearly going to be some parts of the market that are going to be more affected than others by that. But I bring this all up to say that I think the jury's still out on what actually happens to earnings. I think the quarter that we're seeing right now is giving us some room for comfort, but I think we got to be very vigilant as we look into the third quarter earnings season coming up. As we look here, we see the 2-year government bond yield as well as the 10-year government bond yield. You see here that the yield curve is essentially flat. We're not necessarily inverted, but the yield curve is definitely flat. And you can see that 2-year yields came in a pretty fair amount here this week after the GDP announcement. Corporate bond distress. Now, the other thing we've been talking about with regard to fixed income is credit quality. And so far, we've had fairly strong credit. We have not seen a massive erosion in that area. The distress index here, which is from the New York Fed, shows us, though, that at least some of the flags are coming up. We're seeing a little bit of stress in really not only the investment grade, but also the high yield markets. And so this doesn't mean that we're in the midst of a credit crisis. That's nowhere near what I'm saying. And you can see, you've got to go materially higher before you get to that point relative to, what we've seen in the past. But clearly the the distress index is something that we should pay attention to as well, because we know that by and large the corporate balance sheets have been fairly strong, and corporations that have had debt balances, we knew were financing them with ultra low interest rates. And so, it was something that, that we knew that the large part of corporate America would be able to tackle in a reasonable way. But just use this chart as a mechanism to say, listen, this is something that we clearly need to monitor here. I wanted to show this because it provides wonderful perspective and data that goes all the way back to 1980. And it shows you in these red dots that you do have intra-year declines in even the most balanced 60-40 portfolio. And I think it's important to note that, that the first half, I should say, returns in the market were obviously very anemic. And even from the bond side, bonds were down 10.4% as defined by the Barclays aggregate index, and they were down 20% if you look at the S&P 500 on the equity side. So a balanced, kind of almost a growth-oriented 60% equity, 40% fixed income portfolio for the first half of the year was down about 16%. However, I use this chart to highlight the fact that you do often see these intra-year declines, but generally, as it shows here, and then despite these intra-year drops of maybe 7-8% with a 60-40 portfolio, the annual returns in those years where they experienced those drops were up 35 out of 42 years. And so, before we start, like digging the grave for 2022, again, I'm not trying to sound Pollyanna like everything's going to be fine at the end of the year, because, we certainly do have these headwinds with the inflation trend, even though we feel pretty strongly inflation is going to come down a little bit. And recessionary fears maybe will curb demand. Fed will slow its pace of rate increases, and market sentiment will improve a little bit. But oftentimes when you see these episodes where the market is down weak in the first half, you tend to see a better second half. I guess that's really what I'm trying to let you all know here. And our last slide of the chart pack today is just something I found pretty interesting in a Bloomberg article, and not too surprisingly, you've got high net worth individuals in areas that are exhibiting considerable stress. Now, you think about Russia and China, and the confidence number in China is really terrible right now. Even though, obviously China has seen the brunt of COVID, a manufacturing lockdown. You've seen real estate. A lot of real estate loans go bad, and you've got a lot of capital flight. And what's interesting here on China is I think that number is actually a lot more, except China puts capital controls on their citizens, so they literally can't move a lot of their money out of the home market there. You see India, Hong Kong, a function of Chinese authoritarianism, being imposed there, and then Ukraine for obvious reasons, and then you can see some of these other areas that are exhibiting net inflows. Well, that will do it for the chart pack this week. I hope you've enjoyed the analysis here. I'd love to hear from you, and have a great week, and we'll talk to you again soon. Take care.